In March 2023, Silicon Valley Bank collapsed in 36 hours. The second largest bank failure in American history happened faster than most people could process what was occurring. Depositors withdrew $42 billion in a single day through mobile apps and wire transfers. The bank went from solvent to insolvent to dead before regulators could intervene. Most people thought this was an isolated incident, a unique situation affecting a specialized bank serving tech companies in California. They were wrong. What happened to Silicon Valley Bank wasn't an anomaly. It was a preview, a stress test revealing vulnerabilities that exist across hundreds of regional banks throughout America. And those vulnerabilities are about to be tested on a scale that will make 2023 look like a warm-up. Because in 2026, we're facing a banking crisis that will dwarf anything we've seen since the Great Depression. Not from speculation, not from risky trading, but from something far more fundamental and unavoidable: commercial real estate debt. Here's what nobody's talking about. $1.8 trillion in commercial loans are scheduled to mature in 2026. That's not a typo. $1.8 trillion. To put this in perspective, that's roughly equivalent to the entire GDP of Canada. These loans were originated when interest rates were near zero, when office buildings were fully occupied, when commercial real estate seemed like the safest investment on earth. But the world has changed dramatically since these loans were written. Remote work has permanently altered the office market. Buildings that were 90% occupied in 2019 now sit at 50% capacity. Companies that used to lease 5 floors now lease 2. This isn't temporary. This is the new reality of how American business operates. Yet the debt obligations on these properties remain at pre-pandemic levels, based on rental income projections that are no longer achievable. Interest rates have tripled since most of these loans were originated. Properties financed at 3% now face refinancing at 8 or 9%. The mathematics are devastating. A building that barely generated enough rental income to service debt at 3% interest is financially impossible at 8%. The cash flow simply doesn't exist. Property values have collapsed 40 to 60% in major markets because buyers understand the economics no longer work. When these loans mature in 2026, property owners face an impossible choice. They can attempt to refinance at current market rates with properties worth far less than the outstanding debt. They can inject massive amounts of new capital to bridge the gap between property value and loan amount. Or they can walk away, defaulting on the debt and handing the keys to the lender. The third option is becoming increasingly common because it's economically rational. Brookfield Asset Management, one of the world's largest and most sophisticated real estate investors, defaulted on 2 Los Angeles office towers in 2024. They didn't default because Brookfield was in financial trouble. They defaulted because those specific buildings were worth less than the mortgages secured by them. It made no economic sense to continue paying debt service on assets with negative equity. This is happening across America right now, but it's still relatively isolated. Individual defaults here and there, manageable losses that banks can absorb through loan loss reserves. But in 2026, when the tsunami of maturing debt hits simultaneously, defaults won't be isolated incidents. There'll be systematic failures across entire sectors and geographic regions. Here's where the crisis becomes a catastrophe. Regional banks hold the vast majority of commercial real estate debt in America. While the largest banks like JP Chase and Bank of America have some commercial real estate exposure, it represents a small percentage of their overall loan portfolios. But regional banks are different. For many regional banks, commercial real estate loans represent 20, 30, sometimes 40% of their entire loan book. The numbers are staggering. According to Federal Reserve data, over 1,800 banks have commercial real estate exposures greater than 300% of their total equity capital. More than 500 banks have exposures greater than 500% of equity. These aren't small community banks. These are institutions with billions in assets serving major metropolitan areas across the country. When commercial real estate defaults cascade through 2026, these banks will face loan losses that exceed their ability to absorb them. Banks operate on leverage ratios mandated by federal regulators. When loan losses eat through a bank's capital reserves and push leverage below regulatory minimums, regulators have no choice but to close the institution. The contagion effects will be immediate and severe. Modern banking operates on confidence as much as capital. When depositors see news reports of bank failures, they don't wait to analyze the specific reasons. They move their money to institutions they perceive as safer. In the digital age, this happens instantaneously. Silicon Valley Bank experienced a classic bank run compressed into 24 hours. Depositors withdrew funds through mobile apps faster than the bank could liquidate assets to meet withdrawal demands. The same dynamic will play out across regional banks in 2026, but multiplied across hundreds of institutions simultaneously. Banks with heavy commercial real estate exposure will face depositor panic even if they haven't yet realized losses on their loan portfolios. The mere perception of vulnerability will trigger deposit outflows that force banks to liquidate assets at distressed prices, creating the very insolvency that depositors feared. Barry Sternlicht, chairman of Starwood Capital Group, predicted that regional banks will fail every day or every week during this crisis. Howard Lutnick, chairman of Newmark, warned that every single weekend a regional bank is going to go bye-bye. and predicted 500 to 1,000 bank failures in 2025 and 2026. These aren't fringe opinions from pessimistic observers. These are assessments from industry leaders who understand commercial real estate markets intimately. The Federal Deposit Insurance Corporation will face a crisis of unprecedented scale. The FDIC Insurance Fund, which protects depositors up to $250,000 per account, contains approximately $120 billion. That sounds substantial until you realize that the deposits at risk from commercial real estate bank failures could easily exceed that amount multiple times over. The FDIC will need emergency funding from Congress and the Treasury, creating a political crisis in the midst of a financial crisis, but the commercial real estate debt maturation is only the beginning of the perfect storm building toward 2026. The federal government itself faces fiscal pressures that will limit its ability to respond to a banking crisis the way it did in 2008 and 2023. The United States national debt has reached unprecedented levels. Total debt now exceeds 130% of GDP, higher than any time in American history except during World War II. Annual interest payments on this debt are approaching $1 trillion per year, consuming an ever larger share of federal revenue. The Congressional Budget Office projects that interest payments will exceed defense spending by 2026, making debt service one of the largest items in the federal budget. This fiscal deterioration fundamentally changes the government's capacity to respond to financial crises. In 2008, the federal government could credibly backstop the entire financial system because its own balance sheet was relatively strong. Treasury bonds were considered the ultimate safe asset, and the government could borrow unlimited amounts at low interest rates to fund bank bailouts and economic stimulus. That era has ended. The Treasury bond market itself shows signs of stress, with failed auctions and declining foreign participation. International buyers, particularly central banks, have reduced their holdings of US Treasury securities as they diversify away from dollar-denominated assets. When the next crisis hits, the federal government may find itself unable to borrow the massive amounts needed for bank bailouts and economic rescue packages. The Federal Reserve faces equally daunting constraints that didn't exist during previous financial crises. After more than a decade of near-zero interest rates and quantitative easing programs, the central bank has exhausted many of its traditional policy tools. Interest rates currently sit in a range that provides limited room for emergency cuts. During the 2008 financial crisis, the Fed could slash rates from over 5% to zero, providing massive stimulus to the economy. Today, rates would need to go deeply negative to provide equivalent stimulus, a policy tool the Fed has been reluctant to deploy. More concerning is the Fed's balance sheet position. Through its quantitative easing programs, the Federal Reserve accumulated nearly $9 trillion in Treasury bonds and mortgage-backed securities. When interest rates rose rapidly in 2022 and 2023, the value of these holdings collapsed. The Fed now sits on unrealized losses exceeding $2 trillion, the largest loss in the institution's history. This constrains the Fed's ability to purchase distressed assets or provide emergency lending, because doing so would crystallize these losses and potentially require taxpayer support. The international dimension adds another layer of complexity that didn't exist in previous crises. The US dollar's status as the global reserve currency has provided tremendous advantages for decades, allowing America to export inflation and borrow at artificially low rates. But this privileged position is under assault from multiple directions simultaneously. China and Russia have accelerated efforts to conduct trade in their own currencies, bypassing the dollar-based payment system. The BRICS nations are developing alternative financial infrastructure specifically designed to reduce dependence on American financial institutions. Central banks worldwide have increased gold purchases to record levels while reducing dollar reserves. These shifts happen gradually, then suddenly. When the banking crisis hits in 2026, international confidence in American financial stability will be at its lowest point in generations. Oil-producing nations are already accepting payment in currencies other than dollars for energy exports. This strikes at the heart of the petrodollar system that has underpinned American monetary dominance since the 1970s. When dollars are no longer required for essential commodity purchases, demand for treasury bonds diminishes, forcing the US government to offer higher interest rates to attract buyers. This creates a vicious cycle where higher borrowing costs increase the fiscal burden just when the government needs maximum financial flexibility. The timeline for this crisis isn't speculative. It's mathematical. The commercial real estate debt maturities are scheduled events, not random occurrences. Property owners know exactly when their loans come due. Banks know which loans are in their portfolios. Regulators have access to concentration data showing which institutions are most vulnerable. Yet the political and financial establishment continues to operate as if these problems will somehow resolve themselves. The yield curve inversion that preceded every recession for the past 50 years is already normalizing, with futures markets suggesting full normalization by June 2026. This technical indicator has proven remarkably accurate at predicting economic downturns 12 to 18 months in advance. The signal suggests that recessionary forces will be fully engaged by late 2025 or early 2026, precisely when the commercial real estate debt tsunami reaches its peak. Consumer behavior patterns are already shifting in ways that mirror previous crisis periods. Household debt has reached $18.4 trillion, a new record that exceeds the pre-2008 peak when adjusted for population growth. Credit card delinquencies are rising among middle-income borrowers, while wealthy consumers continue spending normally. This bifurcated economy creates instability because consumer spending drives 70% of American economic activity. Small business lending has virtually ceased as regional banks tighten credit standards in anticipation of commercial real estate losses. The money supply measures that typically predict economic activity have contracted significantly from their pandemic peaks. Bank lending for commercial and industrial purposes has stagnated as institutions preserve capital for expected losses. These credit contractions typically precede economic downturns by 6 to 12 months. The political calendar adds another dimension of risk that amplifies financial market stress. The 2026 midterm elections will occur during the peak of the banking crisis, creating a toxic combination of financial instability and political uncertainty. Markets despise political uncertainty, typically demanding higher risk premiums during election cycles. But elections during financial crises create feedback loops where economic stress influences political outcomes, which in turn affect market confidence and economic performance. Congressional gridlock over debt ceiling increases, and budget negotiations will likely coincide with peak banking stress. Politicians will face impossible choices between authorizing expensive bank bailouts and allowing systematic financial collapse. The political optics of rescuing banks while ordinary Americans lose their homes and jobs will be devastating. This political paralysis could extend the crisis and amplify its ultimate economic impact. International events could serve as the spark that ignites these underlying vulnerabilities. Geopolitical tensions in Eastern Europe, the Middle East, and the Pacific create multiple flashpoints where military conflicts could trigger flight to quality investment flows. But unlike previous crises, US Treasury bonds may not serve as the ultimate safe haven if investors question America's fiscal sustainability. A major geopolitical shock during the banking crisis could create a perfect storm where domestic financial instability combines with international crisis to overwhelm policymakers' ability to respond effectively. Markets that expect government intervention might be disappointed when that intervention proves insufficient or unavailable due to fiscal and monetary constraints. The commercial real estate collapse will ripple through the broader economy in ways that extend far beyond banking. Pension funds and insurance companies hold significant positions in commercial real estate investment trusts and mortgage-backed securities. When these assets lose value, retirement security for millions of Americans evaporates. State and local governments that depend on commercial property tax revenue will face budget crises that force cuts to essential services. Construction employment, which has recovered strongly since the pandemic, will collapse as new commercial development becomes economically impossible. Architecture firms, engineering companies, and the entire ecosystem of businesses that support commercial construction will contract sharply. The multiplier effects will spread through communities across America, creating unemployment and business failures in sectors seemingly unrelated to commercial real estate. The psychological impact of watching hundreds of banks fail simultaneously will create panic that extends far beyond the financial sector. Americans who lived through 2008 remember the uncertainty, the frozen credit markets, the fear that their own bank might be next. But 2026 will be different because the scale is larger and the government's capacity to respond is diminished. When people lose confidence in the banking system itself, they alter behavior in ways that amplify the crisis. Cash hoarding becomes rational when bank failures are frequent. Businesses delay investments and hiring when credit markets freeze. Consumers postpone major purchases when they're uncertain about their financial institution's stability. These behavioral changes create a self-reinforcing economic contraction that persists long after the immediate banking crisis passes. The technology sector faces a particularly acute crisis because it depends heavily on regional banks for lending and banking services. Silicon Valley Bank's collapse already demonstrated how quickly tech companies can lose access to capital when their primary banking relationships disappear. Many startups and growth companies maintain relationships with regional banks rather than the largest institutions because they receive more personalized service and faster decision-making. When regional banks fail in clusters, the venture capital ecosystem that has driven American innovation for decades will face severe disruption. Startups will struggle to access credit lines for operations. Growing companies won't be able to secure loans for expansion. Initial public offerings will become difficult when the banks that typically underwrite these transactions are failing or fighting for survival. The housing market will experience a secondary collapse as bank failures restrict mortgage lending. Regional banks originate a significant percentage of residential mortgages, particularly for borrowers who don't fit the standardized criteria of government-sponsored enterprises. When these banks fail, mortgage credit tightens dramatically, reducing demand for housing and accelerating price declines. Existing homeowners will find refinancing impossible when their lenders are closed by regulators. Home equity lines of credit will be frozen or called in early as surviving banks reduce risk exposure. The wealth effect from declining home values will reduce consumer spending, creating additional drag on economic growth during an already severe recession. Agricultural lending faces devastating disruption because farming operations depend on seasonal credit cycles that regional banks traditionally provide. Large agricultural operations require credit for seed, fertilizer, and equipment purchases at the beginning of growing seasons, with repayment occurring after harvest. When regional banks that understand these seasonal patterns fail, farmers lose access to the specialised lending they need to maintain production. Food security becomes a national issue when agricultural credit disappears. Reduced planting leads to smaller harvests, which drives up food prices for consumers already struggling with economic recession. The cascading effects reach from individual farms to global commodity markets as American agricultural exports decline. Municipal governments will face their own crisis as the banks that traditionally purchase municipal bonds fail or reduce their municipal lending activities. Cities and counties that depend on bond financing for infrastructure projects, school construction, and essential services will find themselves unable to access credit markets. Essential services like water treatment, road maintenance, and emergency services will face funding shortages precisely when communities need them most during economic distress. The insurance industry faces a complex web of exposures that will amplify the banking crisis. Property and casualty insurers hold substantial positions in commercial real estate and commercial mortgage-backed securities. When these assets lose value, insurance companies face their own solvency pressures. Life insurers that have guaranteed returns to policyholders will struggle to meet those obligations when their investment portfolios decline in value. Insurance company failures create additional systemic risk because these institutions provide essential coverage for businesses and individuals. When insurance companies fail, the businesses and homeowners they protect lose coverage, creating additional uncertainty in an already stressed economy. The state insurance guarantee funds that typically protect policyholders will face claims that exceed their capacity, requiring emergency funding from state governments that are already dealing with reduced tax revenues. The derivatives markets that connect financial institutions globally will transmit stress from American regional bank failures to institutions worldwide. Credit default swaps on bank debt will trigger payments that strain the balance sheets of institutions that sold protection. Interest rate swaps that banks use to manage their asset-liability mismatches will become liabilities as counterparty risk increases. Foreign banks with exposure to American commercial real estate or relationships with failing American institutions will face their own liquidity pressures. European banks that purchased commercial mortgage-backed securities or provided funding to American real estate projects will realize losses that constrain their ability to lend in their home markets. This creates a feedback loop where American financial stress reduces global credit availability, which further pressures the American economy. The corporate bond market will seize up as investors flee to safety during the banking crisis. Companies that depend on regular bond issuances to refinance maturing debt will face impossible borrowing costs or complete inability to access credit markets. Investment-grade companies will suddenly find themselves unable to roll over debt that seemed routine just months earlier. High-yield corporate bonds will become untouchable as risk appetite disappears entirely. Companies with leveraged balance sheets will face bankruptcy when they cannot refinance maturing debt. The private equity industry that has driven corporate consolidation for decades will find their portfolio companies failing as credit markets freeze. Supply chain disruptions will multiply as businesses lose access to trade financing and letters of credit that facilitate international commerce. Regional banks provide much of the trade finance that enables small and medium-sized businesses to import goods and export products. When these banks fail, international trade becomes difficult or impossible for thousands of companies. The mathematics are inescapable. The timeline is locked. $1.8 trillion in commercial debt matures in 2026 when hundreds of regional banks lack the capital to absorb the inevitable losses. The Federal Reserve cannot print its way out. The Treasury cannot borrow its way out. The political system cannot ignore its way out. What's coming isn't a recession. It's a restructuring of the entire American financial system. And most people have no idea it's already begun.